All right, in this video, we're continuing our discussion of AUC Section 315 for understanding the entity and its environment and assessing the risk and material misstatement. So this video will be our first one, diving into the requirements of this AUC section, and the first requirement is related to risk assessment procedures and related activities. Okay, so before we dive into this in detail, there's a couple of terms that we need to know so that we can understand what they're talking about. So first, we can see that assertions are representations by management that are embodied in the financial statement. And we'll get into this in more detail later on, but you might think of this as these are things that management is implying when they are coming up with the financial statements. And so it would be our job to go in and see whether these assertions are true or not. And some implied assertions that management might have, as an example, related to cash, would be that cash exists. They might be asserting that the cash's value is accurate, and so on and so forth. And there's a lot of different assertions that are detailed in the auditing literature, and we'll get to those later on, but just understand that assertions are things that management is implying when it tells us the balance of a particular account or footnote, so on and so forth. A relevant assertion is an assertion that has a reasonable possibility of containing a misstatement or misstatements that would cause the financial statements to be materially misstated. And so this is discussed in detail later on, but whether an assertion is relevant is made without regard to the effect of internal controls. So when we're trying to decide which assertions are relevant, there are a lot of factors that we might go into, and we'll discuss this later in detail, but our relevant assertions would be those that would be likely to contain a misstatement or that would cause a material misstatement. So an assertion that's immaterial, we might not say that it's relevant, right? And also, in disregarding the internal controls, we would not consider that, hey, management has great internal controls around their cash process, so then that makes this assertion not relevant. No, we can't make that case. We have to decide which assertions are relevant without taking into account the internal controls. And finally, risk assessment procedures. So these audit procedures are performed to obtain an understanding of the entity and its environment, including its internal control, to identify and assess the risk of material misstatement, whether due to fraud or error, at the financial statement and relevant assertion levels. And so the financial statement level would be at the overall, for instance, balance sheet or income statement level, like total revenue, total assets, something like that. Whereas the relevant assertion levels would be drilled down into the account balances. Okay, so now we understand a few terms that will help us kind of understand what they're discussing down here in the risk assessment procedures. So it says that we should perform risk assessment procedures to provide a basis for the identification and assessment of risk and material misstatement at the financial statement and relevant assertion levels. Risk assessment procedures by themselves, however, do not provide sufficient appropriate audit evidence on which to base the audit opinion. So basically, these risk assessment procedures, we're going in to understand the entity, the accounts, how the account balances are determined, all that sort of stuff, things in order to determine which accounts we feel like are likely misstated. And then we would use that risk assessment approach to determine which audit procedures to do. So this risk assessment procedure is very important because it tells us or helps us to figure out how to approach the audit, essentially how to develop our audit plan, which we discussed in the prior video, or rather the prior video series, AUC section 300. So they've got a list here of risk assessment procedures that we need to do. That would be inquire of management and appropriate individuals within the internal audit function, if they have internal audit. Also, others within the entity who, in our professional judgment, may have information that's likely to assist us in identifying risk and material misstatement due to fraud or error. We might also do analytical procedures. We also might observe and inspect. And so all of these have explanatory material sections, so we'll go into these items in detail later on at the end of this video. But for now, let's go through the requirements. So, and next, we should consider whether information obtained from our client acceptance or continuance process is relevant to identifying risk and material misstatement. And that is in AUC section 210. We should also, if the engagement partner has performed other engagements for the entity, then the engagement partner should consider whether information obtained is relevant to identifying risk and material misstatement. So, for example, if maybe we do their tax return or we've done their prior audits and such, then we might there might be information there that would help us in our risk assessment process. Also, during planning, we should consider the results of assessment of the risk and material misstatement due to fraud, along with other information gathered in the process of identifying the risk and material misstatement. So we would have done that in AUC section 240. So we can consider the results of our procedures related to AUC section 240 in our planning process. Also, when we intend to use information obtained from auditors' previous experience with the entity and from audit procedures performed in previous audits, then we should determine whether changes have occurred since the previous audit that may affect its relevance to the current audit. So in our look back to prior audits, whether done by us or a predecessor auditor, we might look to see what has changed since prior years that would maybe change our audit procedures that need to be done. For instance, if this year they bought a new factory, as an example, then we might need to add audit procedures related to the purchase of that factory, whereas that might have not have been present in prior periods. And finally, the engagement partner and other key engagement team members should discuss the susceptibility of the entity's financial statements to material misstatement and application of the applicable financial reporting framework to the entity's facts and circumstances. So the engagement partner should determine which matters would be communicated to the engagement team members not involved in the discussion. So if you remember from AUC section 240, we were required to have an engagement team meeting to discuss fraud-related risks. And so typically in practice, we will, during that meeting to discuss fraud risk, we will also discuss our susceptibility of the financial statements to material misstatement that is required right here. So that engagement team meeting actually ends up being pretty important, not only for the fraud discussion, but also for the engagement partner to supervise the engagement in accordance with AUC section 220 for quality control, but also to assess the risk of material misstatement and tell all the other engagement team members the plan for how do we assess or address those risks. So we see in our risk assessment process, there's a lot of procedures that we need to do. And so to dive into this, we'll go to the explanatory materials section to get a little more details and specifics on how to accomplish all this, and that's at A1 through 23. A1 through 23. So let's go there now. Okay, so now we are down in the explanatory materials sections related to the risk assessment procedures and related activities. So they reiterate here that our risk assessment process is really ongoing and dynamic throughout the entire engagement because we're constantly learning new things about the entity, as well as the financial statement accounts and its environment and such. And so we need to mold our procedures and our audit plan to fit the things that we learn and the risks that we assess through learning that information. And so they note here that by obtaining an understanding of the entity and its environment, including its internal control, we get a frame of reference that allows us to exercise professional judgment throughout the audit. So if we understand the entity and its environment, internal control, we would be better able to notice if something is unusual just from our understanding of the entity. For example, if we have a construction client and we know that their contracts are long-term in nature and straddle year ends, we would expect their revenues to be under a percentage of completion basis. But if we're with that understanding, we would be able to assess once we start going through the audit, if we didn't notice that they had any kind of schedule to calculate the percentage of completion, we would be able to, that would allow flags to go off and for us to see that there's maybe more risk in that area. And that's because we understood the entity and its environment and internal controls. So moving forward, by understanding the entity and its environment, it allows us to assess risk of material misstatement. It allows us to determine materiality because if we understand the entity, then we would know qualitatively what is important to that entity by its stakeholders. By understanding the entity, we also can consider the appropriateness of selection and application of accounting policies and adequacy of financial statement disclosures. So if the entity is in a specialized industry, we would know that there are certain accounting policies and disclosure requirements that are related to those types of entities that we would need to make sure are included in the financial statements. By understanding the entity, we would also be able to hone in on special audit considerations, for instance, related party transactions, going concern assumptions, complex and unusual transactions. We'd also be able to develop expectations for use when we're performing analytical procedures. For example, if we know the entity obtained a big loan this year, but we don't see that loan on the balance sheet when we're looking at in our analytical procedures, then we might find out they included that loan as revenue incorrectly. And so understanding the entity would have helped us to understand what had happened there. And finally, understanding the entity would help us to respond to assess risk of material misstatement and to evaluate the sufficiency appropriateness of audit evidence obtained. Next, we see here that information that we obtain during our performance risk assessment procedures can be used as audit evidence to support our risk of material misstatement. Might also support our audit evidence for a class of transactions, account balances, and disclosures, and related to testing of internal controls. And we might also do substantive procedures in conjunction with our risk assessment procedures if that's sufficient. When we are planning our audit, we want to try to make it as efficient as possible. And so in that way, we can combine a lot of different tasks if we're really knowledgeable about what needs to be done, and that makes the audit go by smoother and also makes the client happier. And so it's good here that they note that the depth of the overall understanding that is required by us is less than that possessed by management and managing the entity. So as we go through these audits, we realize that we're not involved in the day-to-day tasks that management is, and we will never understand the entity as closely and as detailed as management does, and that's okay. We just have to use our professional judgment to understand to what extent we need to understand the entity in order to obtain the reasonable assurance that we're supposed to obtain. And so we remember that our job is to search for misstatements that could be due to fraud or error. And so we know that AUC section 240 discusses the risk assessment procedures related to fraud. So we might go there for specific risk assessment procedures related to fraud, but this overall AUC section 315 discusses risk assessment procedures for both fraud and errors. And so, although we are required to perform all risk assessment procedures described in paragraph 6 in the course of obtaining required understanding of the entity, we're not required to perform all of them for each aspect of that understanding. But there are also, we're not necessarily precluded from obtaining additional information that might be helpful. For instance, reviewing information obtained from external sources such as trade and economic journals, reports by analysts, so on and so forth, or making inquiries of the entity's external legal counsel or valuation specialist who the entity has used. And so the next several sections go through what was required of us in AUC section 315.06. So we see here inquiries of management and others within the entity, inquiries of internal audit function, considerations specific to governmental entities, analytical procedures, observation and inspection, and then it goes on to discuss the information obtained in prior periods, as well as the discussion among the engagement team, which we discussed in paragraph 11. So I think what we'll do is split this video into two sections, or rather several sections that touch on each of these specific areas.